if you look at the MSCI World Midcap Index, which we're measured against, the biggest stock has a market cap of 55 billion US. So that translates into around 74 billion Aussie. So just to put that into a bit of context, that would make it the 8th largest stock in the ASX, just behind ANZ Bank. So these aren't really that small of companies that we're talking about here. However, for our fund, how we define it, we're targeting a universe around 15 billion and below in terms of market cap. And we've always said and continue to say the real sweet spot for us is that 2 to 8 billion range. We find in that area, that gives you real good opportunities for companies that have the opportunity to double or triple over time. And it gives a great opportunity to find stocks that aren't really well covered as well in terms of the overseas markets. So I think there's a real misperception around size and risk when you say mid-small caps. And I think this is especially true in the global context. So when we look at our portfolio, the average market cap's around 9.4 billion US, which is about 12.7 billion Aussie. And if you think what that is, if it put together as one stock, it would be in the top 50 on the ASX. So again, just underpinning that these are large cap companies, they're not small micro cap companies. And one of my goals over the past several years is to highlight that these mid-smalls are firstly not those small companies you might think of first off, rather businesses with multi-billion-dollar market caps. A lot of times they're multinationals. Many times they operate in very strong secular growing markets as well. Many of them touch our lives every day. Even here in Australia, they do. Many of the fund stocks in my fund touch our lives every day here in Australia. It's an asset class that's been one of the strongest performers over a very long time period. And the disappointing thing, but opportunity, is that many Australian investors don't have hardly any exposure to this asset class. So from mine, it creates a great opportunity for people who are looking for diversification to really look at the global mid-small cap. Non-negotiables are, firstly, James, the first non-negotiable is I do have an ESG overlay. So you think of fossil fuels, you think of alcohol, tobacco, those are the easy ones in terms of screening out. But, you know, there's a lot more emphasis on human rights, animal cruelty as well. So if you're to say what's must not to have, it's companies that do harm at the end of the day. I've always talked about this portfolio as a list of companies that are doing good in one way or the other. But the biggest first must not have is anything that does harm from that perspective. So that's the first one, James, from a screening point of view. We look at companies that are going through a period of price discovery. And, you know, the crux of what this fund is very simple at the end of the day. It's all about, you know, connecting to tomorrow's returns today. And what underpins that is that the market is incredibly smart, but it can also be incredibly lazy when companies are going through a period of change. And that change could be a corporate restructure. It could be a spinoff. It could be a new IPO or a management change. There's a number of different criteria that we look at. And that underpins what we look for in terms of that price discovery mechanism. But at the end of the day, when we look for a company, what we love to see is one with high market shares or high recurring revenues, high customer retention rates, operates in a secularly growing market with global context, great balance sheet, great cash flow. That's a great business, but a lot of times that may not be a great stock because a lot of times that will be valued in the stock itself. So when you look at those price discovery mechanisms, it gives you those chances to enter a business like that at a discounted price when they're going through that price discovery time. Yeah, I can give you a couple. I'll give you one that literally just happened about a month ago, James. So it was a company called XPO Logistics. So they owned one of the largest less than truckload businesses in North America, one of the larger ones in Europe as well, a large truck brokerage business, but also they owned the second largest contract logistics business in the world, effectively. So they were going through a separation of the two. And it's amazing how it's a 9 billion market cap company. Amazing how the market inefficiencies can come through in a company that size. So on August the 2nd, when the spin happened, the stock was $138 when you look at them together. Then they spun off into two separate businesses. So two pure plays, one of the larger transport businesses in the world and one of the largest contract logistics businesses in the world. And now the combined group is trading 25% above that in about a month and a half. So that's a great example of a business that, you know, it's gone through this change, gone through a corporate restructure. The market takes time to value each piece of the parts separately. And you know what? That type of return for that size of company is pretty interesting. And it's amazing to see that happen in real time. It just shows that it does work from that perspective.